Howdy, folks. Welcome to the weekly economic update for Monday, July 18th, 2022. Hope everybody's having a fantastic Monday out there. Pretty good weekend here. It was a little toasty, but nothing we couldn't survive. I know the Flatlanders down in Denver are complaining about the near 100-degree heat. But hey, most of y'all probably have air conditioning. Those of us who live out here in the woods, not so much. So anyways, a little disappointing. The Astros lost 2 of 3 to the Athletics. I mean, it just kind of gave away both games, especially the one yesterday, winning most of it, and then just gagged it away. So a little aggravating there, but, they've been a little hurt over the last couple of weeks with some injuries. Jordan's out with a bad wrist, and Brantley's been out with a bad shoulder. Altuve's going to miss the All-Star game with a bum knee. So anyways, they could probably use a few days off, and then they get right back to it on Thursday, doubleheader with the Yankees, and then they fly out to Seattle for the weekend. So it should be exciting once we get this All-Star crap out of the way. It's not very exciting to me because it doesn't count. It doesn't matter. And home run derby's fun to watch, but all it does is screw up your best hitter's swing. So, all right, you didn't come here for baseball news. You came here to hear about the best damn financial stuff in the world, and I will try to deliver on that. So anyways, let's take a look and see how we did today in the markets. Was mostly, looking good until the afternoon, but some news out of Apple really turned the markets in a negative direction. So the Dow Jones finished down for the day, 0.69% at 31,072. S&P was down 0.8%, closed at 3832. The NASDAQ was down 0.81%, closed at 11,360. Small caps were down a third. The VIX climbed 4.42% today. It's currently sitting at 2530. Moving on to the other American exchanges, Canada was up 1.09%, Brazil up 0.48%, Mexico was down 0.2%. Headed over across the pond, Germany up 0.74%, UK up 0.9%, France up 0.93%, the Euro Stoxx was up 1% even. Netherlands was up 1.37%, Spain up 0.22%, Italy up 1.13%, Switzerland up 0.26%. Let's move on over a little further east. The MOEX out of Russia was down 0.62%, while the RTSI was up 0.62%. Headed over to the Asian markets, Japan was up 0.54%, Australia up 1.23%, New Zealand up 0.68%. Headed on over to China, the Shanghai was up 1.55%, the SESE component up 0.98%, the China A50 up 0.98%, and the DJ Shanghai up 1.45%, and the Hang Seng up 2.7%, while the Taiwan weighted came in up 1.16%. So, looking across the day, mostly greens, up greater than 1% in a lot of these cases. And then we hit the United States and kind of crap to bed. All right. So, not the best news, or not the best as far as how the day could have turned out, but certainly not the end of the world by any stretch of the imagination. All right. Well, let's go ahead and read through today's weekly economic update that's going out to clients via email. All right, the week on Wall Street, a record high inflation report, the prospects of a more aggressive Fed and growing recession fears sent stocks lower, though a Friday rally paired losses. The Dow Jones Industrial Average slipped 0.16%, while the S&P 500 lost 0.93%, and the NASDAQ index dropped 1.57% for the week. Internationals lost 3.49%. Stocks slide. As the week opened, recession fears intensified with reports of renewed COVID-related lockdowns in China. Also, the U.S. dollar continued to climb, reflecting global economic weakness. June's consumer price index report showed price increases accelerating. Year-over-year prices jumped 9.1%, the fastest pace in over 40 years. Speculation grew that the Federal Reserve might contemplate a 100 basis point increase in short-term rates later this month rather than the 75 basis point hike it earlier signaled. The market rebounded on Friday following a FOMC member saying he favored a 75 basis point hike. I believe that was Bullard out of the St. Louis Fed. Also helping the Friday rally was a strong retail sales report and additional second quarter company reports. Dollar strength. The increasing strength of the U.S. dollar moved to center stage last week as the dollar index, a measure of the U.S. dollar to 6 other major currencies, reached a fresh high, while the euro fell to parity with the dollar to its lowest level since 2002. A rising U.S. dollar hurt overseas profits when converted into into dollars, and it also makes U.S. products and services more expensive. It's a challenge for large multinational companies that derive a portion of their earnings from overseas markets. Investors may gain greater insight into the extent of that impact as companies provide forward guidance with their upcoming reports. I know it does seem a little counterintuitive that a stronger dollar, could cause things such as, commodities prices actually drop here locally, but that's just unfortunately how the system works out. The week ahead, as far as economic data, Tuesday we have housing starts. Wednesday we have existing home sales. Thursday, jobless claims and the index of leading economic indicators. And Friday is the Purchasing Managers Index Composite Flash. Got a bunch of companies reporting earnings this week. Today on Monday, we have Bank of America, IBM, Goldman Sachs, and Charles Schwab. Tuesday, we have Netflix, J&J, and JB Hunt Transport Services. Wednesday is Tesla, Abbott Labs, CSX, and United Airlines. Thursday, AT&T, Snap, Blackstone, American Airlines, Union Pacific, and D.R. Horton. And on Friday, we have Verizon, Schlumberger, American Express, Next Energy, and PPG Services, or Industries. All right, well, that's everything as far as the economic update for the week. Let's go ahead and dive into today's market commentary. Stocks erased gains to turn negative after report Apple to slow hiring. U.S. stocks turned negative on Monday in the afternoon after an earlier rally after a report from Apple would slow hiring. The markets, gosh, tongue-tied today. The markets had been higher earlier as big banks kicked off another busy week of earnings and expectations eased about big interest rate increase by the Fed. Goldman Sachs beat expectations. Its stock was up 1% after bond trading helped overcome weakness in M&A advisory. Bank of America Corp rose 0.2% after its report also showed a slump in investment banking activity. Both had been up higher in earlier trading. Apple shares ticked down about 1% after reports it would slow hiring and spending, becoming the latest tech giant to make such a move as fears of an economic downturn hit the sector. Investors are betting that the Federal Reserve won't be as aggressive as some were betting last week after the Consumer Price Index for June showed a jump of 9.1% for the 12 months ending last month. Higher inflation stoked fears that the Fed could jack up rates at an uncharacteristically aggressive 1%, but now investors are expecting a 0.75 percentage point increase to match the move in June. That would still be one of the biggest moves since the 1990s. But again, anyone who's been watching along knows that these little nibbles, I mean, it's like, if you're trying to eat an elephant and you're just taking little bite-sized bits, it's going to take forever to eat away at that monster. Officials are trying to tame inflation, helped in recent weeks by a drop in gasoline prices, but still not enough for comfort. Food prices remain elevated as well, and a prolonged heat wave in much of the country means air conditioning bills will eat into household budgets this month. Ha ha! See, I don't have air conditioning. I don't have that problem. I just sweat. Sit in a pool of my own sweat upstairs. This week, we'll also see earnings from Tesla, Twitter, and Netflix. Oil rose. Crude oil WTI futures jumped 4% to $98.44 a barrel, while Brent oil futures crude also rose 4% to $105.23. Gold futures rose 0.6% to $17.13 an ounce. All right. So I guess people are getting a little nervous now that even more companies are starting to slow their hiring. I think it'll probably get worse when they start laying people off because they can't afford to pay them. All right. Next article has to do with oil. Oil jumps on Russian gas supply jitters and a weaker dollar. Oil prices extended gains on Monday, boosted by mounting concerns over gas supply from Russia and a lower dollar, offsetting demand fears brought on by a possible recession and China lockdowns. Brent crude futures for September settlement were up $4.37 or 4.3% to $105.53 a barrel by 12:30 Eastern time today, and having gained 2.1% on Friday. U.S. WTI crude futures for August delivery were up $4.02 or 4.1%. At 101.61 after rising 1.9% in the previous session. Russian gas export monopoly Gazprom declared force majeure on gas supplies to Europe to at least one major customer, according to the letter seen by Reuters, potentially ratcheting up the continent's supply crunch. Gazprom told customers in Europe it cannot guarantee gas supplies because of extraordinary circumstances. And that extraordinary was in quotes. Quote, Brent crude will find support at the end of the week if Russia does not turn the gas back on to Germany after Nord Stream 1 maintenance, end quote, said Jeffrey Halley, a senior analyst at Owanda. A trading source said the letter concerned supplies through Nord Stream 1 pipeline, a major supply route to Germany and beyond. Both Brent and WTI last week registered their biggest weekly declines for about a month on fears of a recession that would hit oil demand. The U.S. dollar retreated from multi-year highs on Mondays, supporting prices of commodities ranging from gold to oil. A weaker dollar makes dollar-denominated commodities more affordable for holders of other currencies. Meanwhile, mass COVID-19 testing exercises continue in parts of China this week, raising concerns over oil demand from the world's second largest oil consumer. However, supplies remain tight. As expected, U.S. President Joe Biden's trip to Saudi Arabia failed to yield any pledge from top OPEC producer to boost oil supply. Biden wants Gulf oil producers to step up output to help lower oil prices and drive down inflation. Again, I mean, I wish we had oil here in America. We could solve this problem, but I guess, it's all just dried up. It's crazy. Oh, wait, there's a ton sitting under Texas. Oh, it's just aggravating. Anyways, all right. And the last article I wanted to read through comes from my buddy John Malden up in Dallas. Well, no, I guess now he lives in Puerto Rico, but it's titled Forgotten Lessons. It's a bit long, so that's why I don't have a lot of articles today. But it kind of, goes through how did we get here? How did we get to such a high inflationary environment? This didn't just happen out of nowhere. I mean, as much as the administration and, the pundits on TV would like to blame Russia and Putin for, the high gas prices today. I mean, this stuff has been baked in for decades now at this point. And that's what this article goes into as far as, what led to the problems we're seeing today. And it's usually not something that happened just now. It's something that, you baked it into the cake, a decade or two in the past and just continued those bad policies, for all these years. And now we're just waking up to the fact that, holy crap, we're in a mess. And, how are we going to get out of this? And unfortunately, there's really no good answers, unfortunately. Excuse me. All right, let's dive into this. Quote, those who cannot remember the past are condemned to repeat it, end quote. It is a well-known quote that's also incomplete. You can remember the past vividly and still have to repeat it. This happens when, for instance, powerful people forget or ignore important lessons that affect everyone. In politics, we often limit the damage by voting out offenders. It's more difficult with institutions designed specifically to avoid such accountability, like the Federal Reserve System. In my opinion, the Fed's failure to heed clear lessons is a major cause of our current economic problems. Today we'll look at an example as we continue to explore William Chancellor's forthcoming book, The Price of Time: The Real Story of Interest. Over the last 2 weeks, including my last letter, John Bull and 2%, we saw how persistently low interest rates have been creating speculative bubbles for centuries. This was well understood long ago by writers like Walter Bagehot. He covered this, Mr. Bagehot's, I'm sorry, I pronounced that wrong. He's a writer from, I think, the 18th or 19th century in England, and he talks a lot about money and credit, even back then, and those lessons really do still apply today, who were well known to Federal Reserve leaders like Alan Greenspan and Ben Bernanke. It's not some ancient secret. Yet these people, whose very job is to know the lessons of the past, either forgot them or chose to ignore them. Today, we'll look at how this manifested in the 2008 crisis period and set up the conditions we face today. At the Strategic Investment Conference in May, we had a special guest who had a front row seat in the Greenspan-Bernanke Fed. Tom Hoenig was Kansas City Fed president from 1991 to 2011, which put him on the policy-setting FOMC that whole period. He said it all began innocently. Here's part from May 27th's Rock and a Hard Place letter. Quote, the initial mistakes seemed innocent. The Fed became more accommodating to markets in the Mexican peso crisis than later with Asian and Russian debt crises. These were indeed bad situations. The Fed had to respond, which it did, preventing the markets from imploding. Wall Street hailed Greenspan as a genius. Yeah, I remember those quotes. This was the genesis of the overconfidence Bill White talked about. And other central banks had it too. Quote, Honig saw early on in the Fed was just bailing out hedge funds. Later, he saw them announcing policies with open-ended for a considerable period commitments. This came to be called the Greenspan put. I think we all kind of knew what was happening, but it's still startling to hear this inside description. Fed officials knew full well their policies were creating asset inflation, higher stock and real estate valuations, etc. They thought that was fine as long as it didn't become broader price inflation, which it wasn't, at least according to the Fed's benchmarks. Central bankers began to think the Fed could manage its way out of any crisis. This extreme hubris helped cause a series of major monetary policy mistakes, leading to the Great Recession and now to a second Great Recession. A few wise men and women sitting around a table thought the enormously complex economy was subject to their simple decisions. It wasn't then, and it isn't now. This is how bad situations often begin. People do something risky, nothing terrible happens, so they push a little more. Eventually, they push too far. Greenspan pushed the Fed away from its previously boring lender of last resort role to a more active market participant. Chancellor describes how it began in 1987. Quote, a couple of months into his new role in October of 1987, Greenspan was confronted with the worst stock market collapse since 1929. I remember that. I was in the 7th grade in my 8th grade, and my Spanish teacher was complaining about how she lost a ton of money. I think it was Black Monday was the day things were so bad. He responded by cutting the federal funds rate and flooding Wall Street with liquidity. The stock market bounced back. Shortly afterwards, the Fed switched its attention from attempting to influence the growth of bank borrowing to directly targeting interest rates, end quote. This is hard to understand now, but for a long time, the Fed didn't manage interest rates like it does now. It mostly focused on keeping banks liquid, letting the market adjust interest rates by itself. Yes, such a thing is actually possible. The 1987 crash and savings and loan crisis that followed seem to have changed that philosophy. I should note that the savings and loan crisis was due to policy-driven error. Again, the government reaching in to save the day. Here is Chancellor again. Quote, after the savings and loan crisis at the turn of the decade, when more than 1,000 U.S. mortgage banks and thrifts failed, the Fed funds rate was cut to below 3%, its lowest level for many years, and roughly half of the prevailing rate of nominal GDP growth. Greenspan wanted to help Wall Street out. Cheap short-term borrowing enabled banks and hedge funds to mint profits by riding the yield curve. A pickup in U.S. productivity in the mid-1990s suggested that the natural rate of interest was rising. At the same time, prices of imported goods were falling and inflation remained dormant. If the rate of interest tracks the rate of return on capital, then American rates should have climbed in tandem. But this didn't happen. Instead, short-term interest rates were held below the growth rate of the U.S. economy for most of that period between early 1992 and the end of the decade. Thus, in the face of positive supply shocks akin to what the United States had experienced in the 1920s, the Greenspan Fed remained accommodating. Another new era beckoned, but so as not to frighten those with long memories, it was renamed the New Paradigm, or the Goldilocks economy, being not too hot and not too cold, end quote. Looking back, that era was clearly the genesis of our current woes. Greenspan, with many accomplices, saw how he could make the markets happy by keeping interest rates lower than circumstances justified. Everyone loved Goldilocks. And as Tom Honig told us, the practice continued through the 1990s as the Fed repeatedly saved the market from various crises. Yeah, it's not really saving us if you're going to kill us in the end. This worked out due to that positive supply shock Chancellor mentions, a perfect storm, the internet boom, European unification, the Soviet Union's collapse, let Greenspan get away with risky policies his predecessors would have never tried. desirable distortion. After a decade or so, the Fed congratulating itself for repeatedly saving the world, Ben Bernanke joined the board in 2002 and became its chair in 2006. With an academic background, we know about those people from the academy. They are village idiots. They might have a lot of knowledge shoved in their head, but putting it into practice usually doesn't work out well. With an academic background studying the Roaring '20s and the subsequent Great Depression, you might think Bernanke would have brought some caution to the Fed. Not so, Chancellor says. He did the opposite. Quote, Bernanke provided the intellectual ballast for Greenspan's practice of ignoring asset price bubbles, since bubbles were said to be impossible to identify in real time. Bernanke said monetary policy shouldn't act preemptively against them, but should deal with them with their aftermath, end quote. Yeah, again, we can see how well that worked out. The fact that the Fed was intimately involved in creating those asset bubbles seemed never to cross their minds. Hubris leads to its own kind of blindness. I think time has shown that this was a terrible mistake. Asset bubbles are a kind of inflation, and fighting inflation is clearly the Fed's responsibility. But consumer price inflation seemed low at the time, so other bubbles may have seemed more tolerable, particularly bubbles representing profit opportunities. No one complains about inflation when it shows up in their investment accounts or housing prices. That's just their reward for being diligent and buying stocks and houses at the right time. With inflation off the table, the Fed shifted to worrying more about deflation, Chancellor goes on. Quote, Bernanke was a strong advocate of acting, this time preemptively, against deflation. Yeah, because lower prices would be awful. If your dollar went farther, that would just be a terrible thing. If necessary, it could drop helicopter money, newly printed dollars, into the hands of the American public. In the spring of 2003, the federal funds rate was cut to 1%. Where it remained for over a year. Over the following 5 years, the Fed's key policy rate remained well below the country's rate of economic growth. The era of easy money had well and truly begun, end quote. The easy money quickly and initially found its way into housing, forming a bubble that would be quite problematic in a few years. Chancellor notes the Fed knew this was happening. Quote, at a congressional hearing in November of 2002, Greenspan noted that the Fed's low interest rate policy had boosted home sales and construction. Mortgage markets, observed by the Fed chairman, have also been a powerful stabilizing force by facilitating the extraction of some of the equity that homeowners had built up. In fact, in the decade up to 2008, Americans extracted a grand total of $9 trillion in home equity. Mortgage equity withdrawal sounds pretty harmless, but in truth, it's a fancy name for households getting into debt, end quote. Chancellor quotes from the transcript of a 2004 FOMC meeting when the then Governor Donald Cohn said their policy accommodation was distorting asset prices. Cohn said, quote, most of this distortion is deliberate and a desirable effect of the stance of policy. We have attempted to lower interest rates below long-term equilibrium rates and to boost asset prices in order to stimulate demand, end quote. Both Greenspan and Bernanke were in the room when Cohn said this. The record shows neither expressed any reservations. Cohn himself called the distortion desirable. So by 2004, the Fed had made a full transition. Its leaders knew their low interest rates were distorting the economy, and they liked it. Moreover, under Bernanke, the Fed made a deliberate decision to ignore asset bubbles until they popped, seeing its job as simply repairing the damage. The housing bubble did indeed pop, causing quite a bit more damage than the Fed seemed to expect. Yeah, I remember that. It wasn't too long ago. Baby steps and blame shifting. All this was quite frustrating situation at the time. Many of us saw the train wreck coming, but we weren't on the FOMC. I wrote about the subprime crisis beginning in late 2006 and all through 2007. Yes, I remember, John. I was quite detailed about the risks involved, and although I underestimated the loss by a few $1 trillion, unfortunately, I did not have the hundreds of millions of dollars in a hedge fund it took to get involved in The Big Short. That's the movie with Christian Bale. But I got to watch it in real time, looking over the shoulders of my friends, which was an interesting view, but didn't make me any money. Even today, some of those on the FOMC who should have known continue denying their low rate set up the crash. Chancellor describes the blame shifting. Quote, Bernanke inclined to a view that poor financial regulation was to blame for the credit excesses prior to the Lehman's bankruptcy. This did necessitate taking some personal responsibility since the Federal Reserve, which Bernanke chaired from early 2006, was the chief U.S. financial regulator. Among policymakers, the regulatory interpretation of the financial crisis won the day. At the same time, the role played by monetary policy in the run-up to the crisis was downplayed. The Federal Reserve's decision to take its policy rate to a post-war low and hold it there for 18 months, keeping the federal funds rate below the economy's growth rate for 5 consecutive years, the extremely slow pace of tightening with rates hiked at baby steps so as not to scare the financial markets, the intentional stoking of the housing market and encouragement of households to get into debt, and the opening of the monetary spigots all were conveniently forgotten. And again, some of these things are what we're doing right now, as far as just these little bites at, as far as raising interest rates, hoping to, slow down things. But at the same time, you don't want to spook the markets, because that would be bad, because you don't want, the big money people coming down on you. Something else happened too. The Fed's policies enabled financial engineering that shifted a lot of mortgage financing to the short end of the yield curve. Quote, the riskiest subprime loans were priced off short-term rates, including the option of adjustable rate mortgages with their negative amortization feature, in which interest was rolled up with the principal. It was only after the Fed's easy money policy was launched that credit growth picked up. Financial leverage soared, housing markets bubbled, underwriting standards declined, and repackaging of subprime mortgage debt into collateralized debt obligations took off. Low interest rates fed the demand for credit, while financial innovation increased its supply. The explosive growth of the market for complex mortgage securities was driven in large part by a desperate search for yield at a time when interest rates were at multi-decade lows, end quote. Let me get a little technical here. Banks are in the business of maturity transformation. They borrow short-term money, i.e. your demand deposit checking account, and use it to make long-term loans, 30-year mortgages, etc. This puts them in an inherently illiquid position, which is why they need a lender of last resort. Many learned this painfully in the S&L crisis, savings and loan. It was still fresh on their minds in the early 2000s. The chance to profitably borrow short while also lending short was pretty attractive at the time. Mortgage securitization also gave originating lenders, i.e. consumer-facing banks, an easy way to transfer credit risk off their books to yield-hungry bondholders. And it all generated very juicy fees every time they sold European pension funds, those subprime mortgage bonds. It was all a virtuous cycle that worked really well until it didn't, hence the Great Recession. Fed policy enabled all of it. The Fed under Greenspan and Bernanke forgot or ignored lessons stretching back to the Bagehot in the 19th century England. You might think that painful experience would have motivated their successors to study the past. It didn't. Janet Yellen and now Jerome Powell continue to disregard history. And there's more to this this article. It is linked in the show notes, so if you want to read through it at your own leisure, feel free to do so. Mr. Malden is one of the brightest economic minds out there. I've been reading him since the last financial downturn, back from what he's talking about in 2007 and 8. And the dude's just right about everything. So maybe not everything, but he's right about most of these things. And he's spot on here. And again, what we're dealing with right now is not a right now problem. This is decades of malpractice, from people who are supposed to be there to keep us out of trouble. And what have they done? They've worried about their own interests and put the American people last, which again, not shocking, especially not to a libertarian like me, who we view that government and their regulators are just crooks. And anyways, all right. Well, that's everything I had for today. I hope you got some value out of this. And if you didn't, I will try harder tomorrow. I swear. But if anyone needs anything from me, feel free to reach out to me. You go to dsafinancialgroup.com and send me an email. My phone number's there. Book a meeting, whatever you like, or just read through the interesting stuff that I put on there. So, all right. Well, hope everyone has a fantastic Monday night, and I will be back tomorrow with the Liberty Call. Hope everyone has a good evening. Bye-bye.